Have you ever entered a trade, followed all rules, and still watched the market move against you? One of the biggest reasons is using the right indicators in the wrong way. In this video, I will show you how to combine the Moving Average Ribbon and RSI so each indicator has one simple job. By the end, you will have a clear strategy you can use on almost any market to find higher quality trade setups. Stay until the end because I have a quick quiz to test what you have learned today. So let's get started. Before we begin, let's reveal the answer to the quiz from my previous video. The question was, in this gold scalping strategy, what RSI period do we use? The correct answer is B. In this strategy, we use RSI 8 because it provides a good balance between speed and smoothness. It reacts faster than the default RSI 14, but it's not as sensitive as very short settings that can create too much noise and false signals. If you got it right, well done. Now, let's jump into today's lesson. Setting up the indicators. First, let's set up the chart. Open TradingView and add the Moving Average Ribbon indicator. We'll make a few changes to turn it into a cleaner trend filter. Set the ribbon to use exponential moving averages with a length of 20, 50, 100, and 200. These four EMAs help us see the market trend more clearly from short-term moves to the bigger picture. Give each line a different color and make them slightly thicker so the ribbon is easy to read. Now add the Relative Strength Index or RSI. Keep the default length of 14. In the Style tab, leave only the RSI line and the RSI upper band visible. Set the RSI upper band to 50 and then click OK. At this point, your setup is ready. Now it's important to understand the role of each indicator. The ribbon shows the direction of the trend, while the RSI measures momentum. Together, they give us a much clearer picture of the market than either indicator alone. Now that the chart is ready, let's see why these two indicators work so well together. The logic behind the strategy. Before we look at the buy and sell rules, let's understand why this strategy works. The Moving Average Ribbon has two jobs. The first job is to show the direction of the trend. When all the moving averages are aligned and sloping upward, the market is in an uptrend, so we only look for buy opportunities. When they are aligned and sloping downward, the market is in a downtrend, so we only look for sell opportunities. The second job is to show the quality of the trend. A healthy trend usually has a wide ribbon where the moving averages are clearly separate apart. This tells us the trend is strong. But when the ribbon becomes flat, compressed, and the moving averages keep crossing each other, the market is losing direction. In those conditions, it's usually better to stay out of the market and wait for a clearer trend. Now let's look at the RSI. The RSI has a different job. It measures momentum. It tells us whether the trend still has enough strength to continue after a pullback. So, each indicator answers a different question. The ribbon asks, is this a strong trend worth trading? The RSI asks, does this trend still have enough momentum to continue? When both indicators agree, we have a much higher quality setup than using either indicator alone. Now that you understand the logic, let's see how to apply it to a real buy setup. Buy setup. Now let's build a buy setup on a real chart. The first thing we check is the Moving Average Ribbon. Remember, the ribbon has two jobs, and we want it to pass both. First, it should confirm an uptrend. The shorter EMAs should be above the longer EMAs, and all four lines should be sloping upward. Second, the ribbon should be wide, with the moving averages clearly spread apart. A wide ribbon tells us the trend is healthy and has enough strength to continue. In this example, the ribbon is wide, well aligned, and pointing upward, so both conditions are met. Now we wait for a pullback. A strong trend does not move in a straight line. Some pullbacks are normal, and they often give us better entries than chasing an extended move. As the pullback develops, watch the RSI. We want it to stay above the 50 level. If it briefly dips below 50 but quickly moves back above it, that's usually fine. The important thing is that bullish momentum returns instead of getting weaker. Notice how the RSI stays around the 50 level rather than dropping deep into bearish territory. That's a good sign. It tells us buyers are still in control while the market is simply taking a short pause. Now we wait for our final confirmation. A bullish candle closes above the high of the previous candle, showing that buyers may be taking control again after the pullback. That's our entry. Place the stop loss below the most recent swing low, and for your take profit, you can target the next resistance level or simply use a 1 to 1.5 risk to reward ratio. After the entry, the price starts making higher highs again. By waiting for the trend, the momentum, and the price to align, we avoid many low-quality entries. If you are enjoying the video so far, don't forget to leave a like. It really helps the channel and lets me know you'd like to see more trading lessons like this. Now let's flip the chart and see how the same idea works in a sell setup. Sell setup. Now let's look at a real sell setup. The first thing we check is the moving average ribbon. This time the ribbon should point downward. The shorter EMAs should be below the longer EMAs and all four lines should be sloping lower. Next, look at the ribbon itself. We want it to be wide with the moving averages clearly separated. A wide ribbon tells us the downtrend has enough strength to continue. If the ribbon is flat, compressed, or the lines keep crossing each other, it's usually a sign of a sideways market, so it's better to wait. In this example, the ribbon is wide, well aligned, and pointing downward, so both conditions are met. Now we wait for a pullback. A healthy downtrend does not move straight down forever. Temporary rallies are normal, and they often provide much better entries than selling after a large bearish candle. After the pullback develops, watch the RSI. We want it to stay below the 50 level. If it briefly moves above 50 but quickly drops back below it, that's usually acceptable. The important thing is that bearish momentum returns. Now we wait for our final confirmation. A bearish candle closes below the low of the previous candle, showing that sellers may be taking control again after the pullback. That's our entry. Place the stop loss above the most recent swing high. For the take profit, you can target the next support level or simply use a 1 to 1.5 risk to reward ratio. As you can see, after the entry, the price starts moving down again and hits our target. Quick quiz. Before you go, let's do today's quick quiz. Which statement is correct? A. The moving average ribbon gives the exact buy and sell signal and the RSI confirms the trend. B. As soon as the RSI crosses above or below 50, you should enter the trade immediately. C. The moving average ribbon identifies the trend, the RSI confirms the momentum, and the entry comes after price confirmation. Leave your answer in the comments using A, B, or C. I will reveal the correct answer in the first 30 seconds of the next video, so don't miss it. If you found this lesson helpful, like and subscribe for more practical strategies. Thanks for watching, and I'll see you in the next video.